At NCS, we solve technology problems where others can't. Challenge us. Search NCS Australia.
The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, he's listened into more calls this week than your average KGB agent. It's Anthony Macdonald. How are you, Anthony?
Earnings eavesdropping all week, James. How good?
Brilliant. Well, this week we ask whether we've hit peak Australia, we give you our most interesting bits from earnings season, and we take a burning question on the housing market. Okay, Anthony, let's start with the best takeover battle raging in corporate Australia, and that's between BlueScope Steel and its would-be suitor SGH, which is the conglomerate owned by the Stokes family. Now, SGH and its American bestie, a company called Steel Dynamics, they raised their bid for BlueScope this week. Is this the offer that gets this deal done?
My gut says no. Big bid, James, $14.2 billion. A lot of money that they're throwing at BlueScope shareholders, but I just don't know that it's going to be high enough, A, to get the BlueScope's board, and then B, to get its biggest shareholder. So $32.35 a share. The bidders are telling us to think about it like $34 a share. Either way, it's about a 40% premium. So it ticks the box on the premium side, James.
Yep.
However, most BlueScope shareholders would say let them in and have a look at the books and let them firm up their bid.
Yep.
BlueScope's got a bigger shareholder, Australian Super, owns 13.5% of the company. And I'm just not sure it likes being backed into this corner, James. So when the bidders turned up with their revised offer, they made it best and final, which is very important in the M&A world. It's like a legal status where you're not allowed to improve it. So these guys have turned up. They're at the front door. They're saying they're very friendly. They're saying they're willing to negotiate, yet they've lobbed an offer that's best and final. So their offer's not going any higher. Australian Super owns 13.5% of the company, the biggest active equities investor in the country. I'm not sure they would see that as friendly and being willing to negotiate when they've got a best and final offer in their face. Now, BlueScope's board's already sort of minded to reject bids, James. We've seen that. I think it's rejected 4 bids in the past 15 or 16 months. So you've got a board that's reluctant. You've got a shareholder probably doesn't like being jammed in a corner. We've seen that over and over in deals in recent years. So I'm just not sure that it will get the traction that they hope. Now, if BlueScope does reject the bid, some shareholders go ballistic. There's plenty of BlueScope shareholders that want to see this company sold for $32.35.
Yeah.
If not, they want to see the US assets sold because they're like, it's a once-in-a-lifetime chance to sell them. Good price, and I get that. But I'm just not sure it's going to pass the test for the rest. What do you think?
Well, given how croaky you're sounding, Anthony, I'm just glad you passed your COVID test and you could be here today with us. I think there's some sort of interesting marketing going on here on the side of the bidders, SGH and Steel Dynamics. Obviously, there's that thing about the best and final offer, but please let's have a nice discussion about where this offer lands. They've said it's $34 a share because they're including a special dividend that BlueScope's board has agreed to pay to its shareholders. I think that's a bit cheeky. The price is what you pay for a business when you get your hands on it. It's a tough one. And I mean, I think it's getting tougher for investors like Australian Super to decide on these things. Yeah, okay. You can take every takeover that comes along when it's good value, but you've got to figure out where you want to reinvest the money. We saw Australian Super hold the line on the bid for Origin Energy. Turned out to be a pretty smart idea. They knocked that bid back. And what we've seen is Origin's value increase markedly because energy markets are tricky and Origin's surfing that wave well. I just wonder if the sort of global shift in markets at the moment, Anthony, is towards companies that do stuff with hard assets, and there's nothing harder than making steel. You know, this business could get more valuable over time, and I reckon that'll play on Australian Super's mind too a little bit. So it's fascinating exchange to watch. You always remind me, Anthony, when SGH was bidding for Boral, it made a couple of best and final offers, which sort of renders the best and final device a little bit useless. So it feels like this has got a bit to play out, right?
I think so, James. You make a good point about Australian super. It would take $1.9 billion off the table if it accepted this vote. $1.9 billion. So like you say, where's it going to put it? Where's it going to put it in this world of uncertainty about AI, business durability, terminal values, all that sort of stuff? It's really quite hard. Taking $1.9 billion from some really hard assets in the ground, impossible to replicate, never to be repeated.
Yeah.
Anyway, I don't think we'll have to wait too long to find out what the next step is.
Yeah.
They've valued this thing, plenty of times in the past 12 months or so. So it shouldn't take them too long to decide whether to reject the bid or let them in for due diligence.
Nothing like a good takeover fight, Anthony.
Now, James, you're always telling us how risky and volatile things are out there. And we've seen some crazy share price moves during reporting season again this week. And yet the ASX 200 hit a fresh record high on Thursday. It's one of several markets in Asia that are absolutely on a tear. Surely even a bear like yourself can get excited about this, James.
Well, markets are weird. There is no other way to describe them. Markets are weird. And I think there's a couple of things going on. As you said, Anthony, people are really struggling to value tech businesses at the moment as this wave of AI disruption comes through. And tech businesses have been the cornerstone of global markets for so long. People are struggling to value the US dollar in this world of sort of heightened uncertainty around Trump. People are struggling to figure out how geopolitics is going to play out. And I think that's what you're seeing on markets. So what we've got is this big rotation. Last year, the last couple of years, it's all been about buy America, buy tech stocks, you're fine. That's all you needed to do. Very, very simple way to make money. All of a sudden, you're looking to shift from tech stocks to hard assets, miners, steel companies, that sort of thing. They're really going well. You're looking to shift away from America into emerging markets in Asia. We're seeing some crazy moves. In the last year, the Korean market, not a place I've looked at too much, Anthony, but the Korean market's doubled in 12 months.
Wow.
Vietnam's market's up 42% in 12 months. Australia's market's done pretty well in the last 12 months too. So what people are seeing there is they're saying AI demand, military demand. What does all that need? Commodities. Who produces commodities? Emerging markets. Okay, we better shift into those. So we're seeing these big rotations on markets that mean that at the index level, at the ASX 200 level, for example, stocks keep going up. But below that, stocks are going crazy. In the first... since the start of February, we've seen, I counted this at the start of last week, there's 45 stocks in the ASX 200. That's 23% of the market have seen their share prices fall 7% or more in one day, just in February. So, yes, at the index level, everything looks hunky-dory, markets at record highs, you beauty. But beneath that, if you've made the wrong choices in your portfolio, you are getting smoked. Anthony, do you think there'll be some fund managers out there bleeding as these big market shifts occur? Not everyone can be in the right stocks at the right time. I think last week, I think it was last Wednesday, for example, we saw CBA skyrocket and CSL plummet. Now, that would have really hurt a lot of fund managers who would have been on the wrong sides of both of those trades.
100%, James. That's an incredibly painful day for fund managers. I reckon this reporting season has been incredibly painful for fund managers. Basically, you just needed to own the banks. They probably didn't own enough banks as they needed to, especially Commonwealth Bank. Commonwealth Bank's taken off on fundies again. So it's hitting portfolios. It's really difficult out there. If you step back though, James, and look at the fundamentals, so the market's at 9,100 points. It looks like earnings per share, should be up 6 or 7% this financial year. So at least earnings are growing. So you could argue that there is some sort of fundamental support for the market going up. However, nearly all that growth is coming from miners. So the miners really are the X factor in Australian earnings. When the commodity cycle's strong, when commodity prices are up, miners' earnings are up, and Australia's markets' earnings are up too. We're sort of in that period now. It just makes you think, imagine if the miners weren't getting such good earnings coming through or earnings forecasts at the moment and everything else is jumping around. I think we'd be in serious trouble.
We all sort of look at the ASX 200 and we sort of watch that index, so closely. But just be careful. The portfolios out there might be taking on water at a much bigger rate than we think. And those, who are managing their own super, who have money with fund managers, they could see some really extreme results from their portfolios because of this period. So watch out. One to watch.
Okay, James, let's get to our first big topic. And this week, the Chief Executive of National Australia Bank, the Canadian Andrew Irvine, issued a warning about the Australian economy. This might be as good as it gets, and we might have hit peak Australia unless we start to see some productivity growth. This came amid a week of growing angst about the state of the Australian economy, including from former RBA Governor Philip Lowe, who said government spending was making the inflation problem worse and we need reform to get the economy going again. James, as a starting point, what does peak Australia actually mean? And should we trust a Canadian telling us about it?
Oh, that's a bit rough. So, hello to all our Canadian listeners. Yeah, of course we should. I think it's actually good to have an outsider sometimes come and break through the things that we always get hung up on in Australia. And Irvine's really good at this, actually, just sort of calling I don't know what they call a spade in Canada, but let's say he's good at calling a hockey puck a hockey puck. And I think he's right. What he's sort of saying here is the point that we've been making about interest rates. What we're seeing is inflation rise despite the economy growing at a fairly tepid rate. As we said recently, the economy is growing about 2.1%. The long-term average is above 3%. But we're already getting inflation creep up again, even at that relatively low level of economic growth. So what that says is the economy's hitting its speed limit. It's reaching capacity. And that's where we get this idea of peak Australia. If we can't improve productivity, then there's not much chance for us to grow faster than we are at the moment because inflation will keep coming back. The RBA will have to raise rates and it'll have to snuff out that little bit of economic growth before it can really take root. I think we should trust Irvine. What he's saying is, hey, 2026, going to be a cracking year. The economy's rolling along. Yeah, the RBA will raise rates, but that'll take a while to come through. But he's looking to 2027 and 2028 after those rate hikes start to hit the economy. And he's saying, unless we can get productivity going, those years are going to be a little bit tougher. And I think that's something that is worth listening to. And Anthony, Irvine's really looking forward to the May budget, the May federal budget, where Jim Chalmers has promised to take action on inflation and productivity. And so I think it feels to me this week particularly, the pressure's been mounting on Chalmers and this budget process. Do you have a sense of what levers he might start to pull?
I agree there is pressure, James, and not just on him, hopefully the whole government. What does it stand for? Come on, you guys got re-elected in a landslide last year. We're 1 year in now. The opposition still hasn't found its feet. Show us what you got. So there's a bit of talk about the budget out there, James. I mean, the biggest sort of structural change could be the capital gains tax discount, and that's the sort of place to start, I think. Yep. Now, so capital gains tax, it's a tax on assets and wealth, James. I mean, that's something you in particular have really sort of liked to talk about on this podcast for the past year or so, changing up the tax base and going after where there probably is a bit of money that the country could grab. So at the moment, when you sell an asset and you realise a gain, you pay tax on only half of that gain. They call it a 50% capital gains tax discount. Now, you pay tax at your marginal income rate, and it's not quite as simple as what you pay for an asset versus what you sell it for and pay tax on the difference. Yep. You can include other things in the cost base. But, if you just think of it that way, it makes it easier. So the government's seriously considering cutting that discount back to, say, a third. Right, and it's something that would raise money for the budget. It means that people that were selling assets would have to pay more of the gain away in tax. And I think the Parliamentary Budget Office said it could raise about $237 billion in the next 10 years. So it's big money. I mean, the government's had this out there for a few weeks now. It's been getting feedback on it. The BCA, the big business lobby group, they came out and said this week it would support it so long as new homes are exempt.
Right.
It doesn't want to crimp investment in the new housing market.
Yep.
But I think the overall theme is intergenerational inequality. Tax those with more assets, help out the rest, Robin Hood sort of stuff. Could knock a little bit off the top of the housing market in terms of prices. So Chris Richardson, the economist, say it could knock 1 or 2% off. So not make a massive difference in house prices. So at least there's a bit of discussion though about tax reform. Hopefully there's more. I mean, it's only February, James. We've got another 2.5 months to the budget, so I'm sure we'll get more leaks
Good point.
as it gets closer. At least there's a bit of movement there.
It's been interesting, Anthony. Like, they've clearly flown the kite on this one. You know, they've
Big time.
put it out there, let it be kicked around, which I think is a good thing. I'm not sensing a whole lot of pushback. Like, I know the new opposition leader, Angus Taylor, who we'll get onto in a minute, I know he sort of said, oh, no, we won't be doing that. But I haven't sensed that this has, got the community up in arms.
This is one of those ideas that's been around, James. It was in the 2010 Ken Henry tax review.
Of course.
16 years ago. It was big news at the time, that tax review. It had a heap of ideas in it. This probably wasn't one of the more high-profile ones, but the idea's been around. It makes sense. And if you've got the political power to get something through, it could be a decent change.
Yeah.
James, let's bring a reader question here from Matt, who says that Gary Stevenson, he's the wealthy former investor and trader who's become an author and crusader on wealth inequality. He's currently in Australia talking about the wealth gap and housing affordability worsening by the day. Matt's wondering why the government isn't addressing the issues of means testing for the pension and stamp duty on housing. The combined effect currently encourages the elderly to remain in large, expensive homes, accumulating inheritance for their children while drawing a taxpayer-funded pension. Matt says it seems to him to be low-hanging fruit to replace stamp duty with a land tax and means test the pension. It would become cost-effective for elderly residents to downsize, and hence inner-city housing supply for families would become available. And the government would save taxpayers money as well. James, why isn't this on the agenda?
Treasurer Matt, I think, has put it on the agenda. And look, again, ideas that have kicked around for a while. The New South Wales government under Dominic Perrottet tried to start the process of moving towards land taxes. Didn't go very well, but it is an idea that does have some merit. I mean, stamp duty is pretty regressive and it disincentivizes moving in and out of properties because, you pay it when you buy something. So that makes it harder to get into the market, but it also means that you're more likely to stay in your current property because you don't want to pay stamp duty on the next one. And so we get these older Australians staying in their homes for fear of copping a stamp duty bill down the track. Whereas land tax, the idea here is that you pay it every year on the value of your property and depending on how that moves around. And, that's fairer and takes away those disincentives to moving. That's one idea. And then the means testing of the pension. Look, Matt, I think this sort of thing will become on the agenda. It'll get howls of protest for sure, but something like that as the working population shrinks and the number of taxpayers paying income tax is reduced, we can't keep whacking workers to pay for the healthcare costs of older people. We're going to have to think about some wealth taxes, and the suggestion that Matt has there is possibly one of the ones that's going to have to be involved. Anthony, though, to me, the levers here are important, but also what's important is the ability for politicians, whether it's Jim Chalmers and Anthony Albanese or whoever, to sort of sell the story. And I think that's what some of our corporate leaders are trying to do. What they're trying to say is, unless we get reform right, our living standards are going backwards. I think there's an easier way to sell that. Unless we get this right, your kids and your grandkids will have worse living standards than you. Now, do you want that, or are you prepared to make a couple of sacrifices, not big ones, just little ones, to try and prepare the way for the next generation, to try and leave the place better for the next generation? I think if Chalmers and Albanese can't do this at this time, with the big electoral majority they've got, with the opposition in a rabble, then when are they going to do it? This is surely the moment to try and bring the community along, introduce some ideas. We're all in this together. We're all staring into this world of AI and climate change. Let's do something about it. Let's get on the front foot. This budget is a big moment for the government, but Anthony, it's also a big moment for the coalition. We mentioned new Liberal leader Angus Taylor, and he's now got Shadow Treasurer Tim Wilson working with him. They will get to do a budget in reply speech a couple of days after the federal budget's released. And surely the acid's on them too a bit, isn't it? What's their alternate plan for the country?
It's the perfect opportunity for them, James. Like, seriously, most Australians wouldn't know that Tim Wilson's the Shadow Treasurer, let alone that Angus Taylor's leading the opposition. It's a big chance for them to establish themselves as credible, throw some ideas out there, get themselves a place in the debate about productivity and living standards and reform, because they should have a seat at that table around the whole debate. Yet they've kind of been missing for the past 12 months because they got so flogged in the election and then they've been fighting amongst themselves. So, something like the budget reply speech, James, it's a set piece. They get airtime. They're guaranteed a chance to have their say. Australia hopefully will be interested, or at least a little bit interested. And there may be something meaty to chew on, something like the CGT discount changes. Maybe more, who knows? But the Libs need to win more votes in cities. Teals have completely eaten their lunch. They particularly need to win more votes from women and younger women. So they're going to have to come up with some policies that appeal to those demographics. I mean, it's an absolute no-brainer if they want to have any chance at the next election, let alone the one after that. But I agree with you, James. The asset is on them to come up with something. And in 2 months' time, they're going to have the chance to have their say. So what better time is there?
The countdown to the budget begins. It's going to be a big month of May. Okay, Anthony, let's get to our second topic. And as I said at the top of the show, we've both been spending the week on calls with CEOs because we are smack bang in the middle of that wonderful biannual corporate festival called reporting season, where for 3 weeks, every ASX company fronts the market and lays out their financial results. Now, Anthony, I want to dig into some of the big topics in a second. We've got to start with some of those wild, crazy share price movements that we've been seeing. As I said, 45 members of the ASX 200 have seen their share prices move more than 7% on a single day in February. But some of the moves are extraordinary. Big name companies moving 25% in a day. We even saw one fall 40% on Thursday. You said this week that the ASX feels a bit more like a casino. What's going on here?
The move's extraordinary, James, and I think it links a little bit back to what you were talking about earlier with just this big sort of rotation that's going on in markets. But results are also feeding into it. So if you just look at Thursday this week, I think we had 7 companies' shares were down more than 5% on Thursday in the top 200, 7 out of the top 200, and we had 10 out of the top 200 that were up more than 5% on results. The swings are just huge. And Zip, which is a pay in 8, pay in 4, pay in 2 installments company, particularly targeting the US, but also here in Australia, it sank an unbelievable 34%. But like you said, it was down close to 40% at one stage. So this isn't normal. And I wrote a column earlier this week pointing that out, James, and trying to solve it, look at why at least. I got more feedback on that than anything else I've written this year. It's fair to say it's a big talking point out there in markets. There's a lot of different views as to what's going on, a lot of different views as to whether it's a problem or an opportunity or markets acting efficiently or inefficiently or what. And, we could take out the whole episode debating that. But basically, if you look at a few things that are going on, there's fewer big active investors in the market to take the other side of a trade. Yep. So if a company like Wesfarmers looks like it's going to open down 5% on what was a pretty, inline result like it did on Thursday, in the old days you get 1 or 2 of the active investors saying, hang on, I'll buy a bit of that. Yeah. And it wouldn't be minus 5% or at least not for very long. So at the same time, you got the fewer active guys in the market. The money's gone to the passive funds. So you got this rise of these like ETFs and index investors. Now, all year round, these passive funds just buy stocks based on size, not their earnings outlook, their operating environment, or anything else that could be revealed on results day. This distorts prices or at least changes the way that share prices are set. And then on results day, everything's about fundamentals. Everything's about earnings and earnings outlooks and margins and guidance, whatever. So you can get this one day big correction to the passive flows that have been there. And then the third thing, James, is just the rise of high-frequency trading, hedge funds, quant funds, basically all the computer trading out there. Once again, big structural change in the Australian market. And the ones getting the most blame are the hedge fund pods. So these are mostly American hedge funds that have set up these sort of like little teams all around the world, and they trade very heavily around known catalysts, catalysts like results days. They can take a position pre-result and then expect a company to hit, miss earnings or whatever, and then trade out of it soon after. So they don't stay in their positions for very long, but they can do it at quite big volume relative to what else is in the market, and they can really move share prices around. So we've seen a lot, James. I mean, for me, the share price moves are one of the standout features of this reporting season. But if we step back for a minute, I think we should try and give investors something a bit more useful than me saying, share prices are going up and going down. Have you got any themes that you've picked up on this reporting season that are a bit different to what we've seen previously?
Yeah, well, I think the biggest one is AI.
Yep.
It is in every company's presentation. Everyone is talking about it, from GYG, the burrito purveyors, to CBA and everything in between. Everybody's having a crack at this. And I think what people out there need to realise is the experiments are happening.
Yep.
They're happening in great scale right across businesses. There's lots of different experiments. Everyone's doing it. I think we've hit a bit of a tipping point here, Anthony. This isn't like a theoretical thing that might happen. This will happen. What we're seeing in 2026 is companies wrapping their heads around the risks, getting comfortable with the risks. When they set these AI agents out into the wild, dealing with customers and dealing with their own staff, there's going to be consequences that they don't expect. You know, there's going to be stuff-ups with the way customer engagement happens. There's going to be AIs giving out crappy advice. There'll be staff inside businesses who quickly figure out how AI is taking their jobs. So boards need to get their heads around those risks. How are we going to deal with them? What's our strategy going to be to talk to our people about it? How do we talk to the media about it when they inevitably come out? But that work is going to happen in 2026, and the dam will break. It's just how competition works. One bank or one retailer or one energy company will start with this thing. The others have to follow. And so I think we have reached a bit of a tipping point. That's why you're seeing these sell-offs in software companies, because people are out there thinking, yep, this is here now. So how do we value that software company that we've always held in high regard? They seem to be doing okay now, but how are they going to be doing in 12 months' time, 18 months' time, 2 years' time, 3 years' time? So I think the AI story is the big one for me.
I agree with you, James. AI is everywhere, isn't it? All the companies are talking about it. The thing is, though, they're all saying they're embracing AI. They all know that AI disruption is out there, but it is not happening to them. You know, like it's this big theme in markets this year is that AI disruption. Like you said, we've seen these software companies sold off because everyone's worried about their businesses getting eaten by AI's ability to write its own code, create its own software, and really seriously disrupt the incumbents. Even the software companies, James, though, they are trying to turn that sort of disruption fear on its head. They're saying, we are big AI users. We have been for 10 years. We are using it internally. We're making our products better. We are using our product development team. We're using the AI. And then we're using this whole big thing of proprietary data that we have that no one else can get their hands on. We're combining that. And that is what is our moat and what is protecting us against disruption from AI. But James, everyone knows there's AI disruption. It's got to happen. Like, industries change. So what we've got is we've got companies that are standing up on results day, you know, Seek, which owns car sales, REA, whoever. They're doing a great job of explaining about how they're using AI, how they can be a winner from AI. But, you know, no one's going to put their hand up and say that they're going to be disrupted. So that's the other thing. I think there are heads in sand a bit, and investors are the ones that are trying to work out the winners and the losers. They're playing out at the same time as results season. So it's really been incredibly interesting from that standpoint. What else have you picked up, James?
Costs is the other big theme. Everyone's thinking about inflation, and you can see that inflation in the cost bases of our big companies. Holding your operating expenses to sort of 4% growth or 5% growth, that's a pretty credible effort in this economy, given how wages are increasing in unionised sectors and how software costs are going up, ironically. So if you're Microsoft and you're pumping hundreds of billions of dollars into CapEx for AI, you're trying to recoup that by making sure some of your other products are selling at pretty high prices. And we're seeing that. So everyone's baking in, 4 to 5% cost growth. Anyone who can swim the other way is doing very well. I think we saw a great example of that on Thursday from Telstra. They reduced their costs by more than 2%. That is a big effort in the current environment. I think we'll continue to see this cost story playing out as inflation bites, because if you don't attack your costs, you're going to see your profitability come under pressure, particularly if your pricing power is not that good. So watch for this cost and inflation story to get even bigger over the rest of the financial year. Anthony, another trend to finish us off?
Results have been pretty good, James. I think corporate Australia's a pretty healthy position. It's a bit boring to say it, but really they've consolidated in this post-COVID era. They got through the worst of the inflation, were helped along by the rebounding consumer and generally pretty good shape. In the past 6 months, the rate cuts started coming through. I mean, inflation's taken off. But I think we'll look back at this 6 months just gone and go, we had it pretty good. Maybe to Andrew Irvine's point that we started the show with, James. So I don't think there was so much expectation among investors that business was probably going to be as healthy as it is. There haven't been really that many absolute shockers in terms of the results. I mean, while share prices have been really moving around wildly, 30, 40% drops, no one's going broke. No one's announcing massive write-downs or restructuring costs. No one's talking about, insolvency and safe harbor protections or anything like that. So I think maybe we are at peak Australia. The rate rises are coming. It's probably going to get a little bit harder for business, but we've just come through this 6-month pocket where everything was actually pretty good.
Yeah, and I think it'll probably continue for another 6 months. But as those rate hikes start to bite, that's when you'll see things come off a little bit. And I think you're right. What Irvine's saying is correct. 2026 is going to be pretty good. It's 2027 and 2028 that'll probably have the bigger question marks. Okay, Anthony, we'll come back after the break. Another big week. We get some key economic data that will help determine where interest rates go next. Back in a sec.
It takes a certain type of person to succeed, the type that puts in the work when no one's watching, that knows staying informed isn't optional. It's their edge. It's not for everyone. The Australian Financial Review, the daily habit of successful people.
Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Okay, Anthony, last big week of earnings season. Rush towards the finish. We've got the plumbing group Reece on Monday. We've got Woodside on Tuesday, Fortescue, Woolworths and WiseTech on Wednesday, Qantas on Thursday, and then we bring it all home with the other big supermarket player, Coles, which is on Friday. That'll be a bit of relief given they've spent this week in the federal court fighting the ACCC on those dodgy discounts. So another big week, Anthony.
Absolutely, James. One more week just to really finish us off.
Okay, on Tuesday night, I'm at the University of Melbourne's Economic Faculty and I'm interviewing Michelle Bullock, the Governor of the Reserve Bank. So that'll be interesting. I'm not sure she'll give us too much new information on where rates are going, but we'll get a bit of a sense of her story and where economics fits into the world at the moment. So should be fun. What's
the burning question, James? Are you allowed to reveal it?
Oh, well, I think, how she's seeing the risks in the economy. That's what this is all about. The RBA's got this two-sided mandate, jobs on one side, inflation on the other. So hard to balance. So hopefully we'll get her a bit on that. Speaking of inflation and where it's all going, on Wednesday we get the monthly inflation reading. These can be pretty volatile, but Anthony, I think anything that says where inflation is at the moment is going to be pounced upon by the market, isn't it?
Oh, absolutely, James. And, the RBA keeps telling us it's data dependent. Well, this is a data point, even though it also says in the same breath that the monthly inflation data is volatile, does jump around, and it's not fully reliant on it. This week we've got the jobs data, James. Unemployment of 4.1%, jobs market's tight. So I noticed some of the economists now talking about another interest rate rise sooner than expected. So inflation all just feeds into the mix.
And this stuff is really feeding into the ASX at the moment too. If you look at some of our property companies, how they traded on Thursday, they were all going okay. And then the employment data came out. Everyone thought, rate hikes. And that really weighed on the property sector's share prices, even though the property sector's performing pretty well at the moment. So it's really starting to flow through to the shares, which is quite interesting. Okay, we love questions on the Chanticleer podcast. We had one earlier from Matt, and we've got another one from Pip in Burleigh Heads. If you've got a question you want to send in, you can email us at chanticleer@afr.com. We've got the link in the show notes, and you can also send your question in audio form. Just record a voice memo on your phone, include your name and where you're from, and there's a widget on the bottom of Chanticleer articles at afr.com that also allows you to ask questions. Okay, let's hear from Pip in Burleigh Heads, who's got a voice question for us.
Hi, Chooks. Pip from Burleigh Heads. Love listening to the podcast when I'm driving. James, I think you're better at tipping interest rate movements than you are at AFL Grand Final results, but I'm a Brisbane Lions fan, so I don't mind too much. On the podcast last week, you talked about how 3 CEOs of some big companies had all departed around about the same time for various reasons. And I was wondering if you had some good stories about some companies who did well after a very prominent, well-known CEO left them. Thanks, Chooks.
Oh, thanks, Pip. Good luck with the Lions this year. You certainly got bragging rights in that discussion, that's for sure, as with the Lions being the reigning premiers. This is a really interesting question, Anthony. We saw the CSL chief executive, the chief executive of ASX Limited, and the chief executive of Lendlease all depart last week. And all 3 companies are in sort of, I guess, different stages of disrepair. And the turnaround can be tough, but can it be done? Are there some examples that you'd give us, Anthony?
Absolutely, James, there's examples. I mean, the most obvious one, without wanting to steal yours, is Vanessa Hudson at Qantas.
Yeah.
I mean, Qantas wasn't in disrepair, but it was definitely at the height of a customer service-led storm coming out of the pandemic. Its customer base was just absolutely fired up, and then the whole thing boiled over. Ended up Alan Joyce left, and it was up to Vanessa Hudson to settle it all down.
Yeah.
She's done that quite well, James. So it's all settled down. It's been very good for investors. You know, that big steady ship just keeps sailing. Just a recent one, Pip, for you. Simon Trott at Rio. So he was installed as CEO, 6 months ago, James?
Yeah, about that.
Took over from Yakov, quite unexpected at the time when Yakov left. And it was sort of perfect timing if you look at what's happened in the way to Rio's share price, this demand for commodities and everything. But Simon's come out, he's put a new strategy to investors. It's all about simplification and sort of sweating the assets they've got harder than they have in the past and focusing on costs and all that sort of stuff. Quite ironic that they then went and bid for Glencore. But if you just believe that strategy pitch, I think he's selling a message that investors really wanted to hear at the time they wanted to hear it. And they're laughing now. The share price just keeps hitting new record highs. Who else comes to mind for you?
Oh, a couple of the banks, Anthony. I think we can forget now that Matt Comyn arrived at CBA when it was in a state of crisis, there's no other way to say it, and has turned that business around well. And a National Australia Bank. Ross McEwen came in after the very sudden departure of both CEO Andrew Thorburn and the chairman Ken Henry, and steadied that ship, turned it round, made it into a favourite with investors. But Pip, I reckon there's a bit of a secret in the names that we've listed. You've got to have a big company with a very strong market position. All of the ones we've listed are either maybe not oligopolists or monopolists, but they're not far off it, that they've got very strong positions in their markets, and that means that the underlying assets are good, the business is fundamentally good, the market position is good, and the turnaround's possible. I think that augurs well for the CEOs of CSL and ASX that do have very strong positions. The next CEO of Lendlease is probably going to struggle. And I think there's lots of examples where it can be hard to turn around a business model where there are some real cracks in it, Anthony. Once the business model started to go south, it's not easy to bring it back. So, yeah, some of these jobs can be poison chalices and some of them can be perfect timing because you get the business at the bottom of the cycle and away you go.
Yeah, great point you make there about market share and market position, James. You're right. You know, I mean, Qantas was number one, you know, whether Joyce is running it, Hudson, whoever.
Exactly.
Commonwealth Bank's still the biggest bank. NAB's still the best business bank. Rio Tinto still got China as a massive buyer. Go back another one, James, Vic Bansal from Boral, right? So Boral was a rudderless ship when he came in 5 years or so ago.
Yeah.
It had bought and sold out of the US. It had stuffed up its Australian business. He came in and he just pushed basically price and cost in Australia, refocused on what it's good at, which is concrete, focused on margins. And I mean, they're laughing today, even a pretty tough resi construction environment. So you're right. If you got something the world wants to buy, it makes it a whole lot easier.
Yeah, for sure. All right, Anthony, it's been a massive week. Can't wait for next week. I think we're really going to see the guts of corporate Australia sort of exposed a little bit across energy, across manufacturing, across retail, where we really get a sense of what the consumer's doing. So it's going to be great fun. We'll dive into all those results next week, but you rest up because it's going to be another big one.
Yeah, reporting season can get quite hairy in that final week, James, so let's watch out.
Thanks for listening. We can't wait to talk to you next week. If you like the podcast, send it to a friend as it helps others find us. And don't forget to follow wherever you get your podcasts so you'll never miss an episode. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Mandy Coolin, and our theme is by Alex Gow. Head of Audio is Alex Gow, and Head of Premium Content is Fiona Buffini.
The Australian Financial Review.
It takes a certain type of person to succeed, the type that puts in the work when no one's watching, that knows staying informed isn't optional, it's their edge. It's not for everyone. The Australian Financial Review, the daily habit of successful people.